The Honest Money podcast is powered by 10x Investments, a licensed financial services provider. Consult with your financial advisor and let's 10x your future together.
Welcome to Honest Money. I'm Warren Ingram.
It's Pieter Villiers from Money Marks.
So today we're talking about something that could well happen to a lot of us in our lifetimes, and that's what happens when you get to financial freedom and you decide, okay, I've done it. I'm going to stop work, and you get to that number and you get to that point, and it's the middle of a major market. Even if it's not a major market crash, it could be the middle of just a really bad time in the markets. What on earth do you do next?
Yeah, and it's a very relevant thing, because whether that's financial freedom or maybe you're just at the point of retirement, just traditional retirement, and now suddenly you see this on the news, you hear everything, because we always hear the bad things. Oh, the S&P 500 is down 10%, or the JSE top 40 is lowest in the last year. It's a lot of anxiety that comes with it, because you've now worked so many years, worked hard. You've got that number that we spoke about in the previous episode, that financial freedom number. You've hit it. You finally got there. And now suddenly you see all this wealth you've built up is now there's a market crash, let's say 10, 20% drop. What do we do there? Do we now panic and just say, like, this whole market investing thing's a scam, I'm putting it in the bank and, it's safe? Or do we continue working for longer? Or what do we do? And it's a very normal thing to panic. It's our human nature, our feelings towards loss aversion, meaning when something bad happens, it's much stronger to gaining. If you have an example of making 1,000 Rand extra or losing 1,000 Rand, the feeling of losing 1,000 Rand will be much stronger than making 1,000 Rand. That's just how we are designed to be. So do we fight or flight? What do we do? That's what we're going to flesh out today.
Yeah, and I think that there are a couple of things to understand. There's the psychological journey that you will go on as a human being, and just being aware of that is important, so that you can at least just give a name to it. And then when the alarm bells start flashing, you recognize what it is, and you go, oh, okay, this is an emotional reaction I'm having, and it's normal, and lots of people have it. That doesn't mean you then continue to react emotionally. Giving a name to it hopefully helps you to develop some tools to cope with that.
Yes.
But there is the other side of that, which is understanding that markets do this all the time. And there is a lot of research available. There's lots to read about this stuff. But the one thing I really like is, in almost every single calendar year, in other words, 1 January to 31 December, in almost every single one of those, going back 100 or 200 years, the stock markets will fall by about 10% in most of those years. So somewhere in the year, your investments will go from $1 million, they'll be sitting at 1.2 million, you'll be feeling like a genius. And then all of a sudden they go from 1.2 million and they go back down to like 1,050,000. And then you think the world has ended. I mean, you started the year at $1 million, it's gone up to 1.2, you're at 1,050,000. Actually, you haven't really lost anything. The markets have just gone up and down. But what happens now, you've lost 150,000 and you think the world's ended. And if you just do nothing, you stay the course, you get to the end of the year, there is a good chance that your million has gone from 1 to 1.2 down to 1,050,000, and you might be sitting at 1.1 or 1.15 or whatever, and that would have just been a normal market year. Reacting emotionally to that kind of volatility, not very healthy. It keeps you awake at night. It's not good for just your psychological well-being, but equally doing anything about it from an investment point of view, in other words, switching or making a change, is a really terrible idea. So understanding that the markets move a lot like the tide. So when you start investing, and you can't be surprised that the tide goes up and then you think, well, I'm the genius because my investments went up. Equally, when the tide goes down, you can't panic and say, okay, now I'm going to go to cash. This whole thing is a scam, like you said. It's normal. That's what happens in markets. So the psychological journey is getting yourself ready for that. And then number two, I think understanding who you are as a psychological person. Do you have that loss aversion that kind of just overrides all logic and reason because you're going to have to do something about that? Or can you kind of tolerate it and deal with it? It might not be nice. No one wants to see their investments go down. But I think it's preparing for the two parts, the the reality of markets and then who you are and the person in the mirror.
Yes, it's very important because money is not only a technical numbers game. It's very much emotional, even more so in an emotional thing, because oftentimes big mistakes that people make is not necessarily what they do, but what they don't do. And when market crashes happen, probably the biggest mistake that you can make is panicking and panic selling, because now I logged in today and now it was yesterday it was 5% loss, now it's 10%, tomorrow it's going to be 15%, so I'm just going to sell it off and put it in the bank. That's probably one of the worst mistakes that you can make, because now if on paper, let's say you log into your platform, you see there's a loss, it's a paper loss. It doesn't mean anything until you go and sell. Then you realize that loss, and now it's like stamp on it, you've made a loss. So it's keeping with the course, and there's a difference between when you accumulate investments, when you invest and you build wealth, versus when you start drawing down from your investment. So we've talked a lot about the accumulation phase, which is usually, if the markets go down, that's great because now you can buy at a discount, so invest more. But now, let's say you've done that now, you've got your pot at the end of the rainbow, you're retiring, now you're drawing money from your investment portfolio that's also now dropping. Now, we know from the previous episode that ideally we want to make sure that the amount we withdraw is more than what it's at least matching the after-tax, after-fees amount. So let's say you've got a 10% return, inflation is 5%, fees is 1%, and you're drawing 4%. Then you effectively, in real terms, even out at zero. But now let's say, all right, I'm getting 8% return, but inflation is 6% and fees are 3%, and I'm also drawing another 3%. Now I'm 4% behind. Now I'm losing capital. And that is a big risk that we need to be aware of. A bit more technical term is the sequence of risk. If you retire and in that specific year or 2 or 3, there's a massive market downturn and you're drawing income from your capital, but usually where you would have want that to happen is the extra growth is the income that you draw, but now you're actually going into your capital, and that decrease in capital could mean trouble later on in life. So yes, that is a risk. So practically when that happens, let's say that is now a situation where you've built up wealth, it's a market downturn, 20% crash. What practical things can people think about doing to try and mitigate this risk as much as possible, at least decrease the risk or make it more tolerable?
And just just to state the obvious, there are probably 5 human beings in the world that can lift stock markets up by themselves. So the one thing you can't do is impact your investments. You can't make your investments recover. They're going to do what they're going to do, and unfortunately, you're along for the ride. Yeah. So you've got to make sure that you start by saying, if I've correctly structured my investments up front, then understanding that this is just a normal market correction, and what I'm not going to do is go and impact the investments. The only things you can control in that situation will be how much you draw from your investments, and then what else you can do to supplement your income, for example. I think the starting point is if this is a straight retirement, in other words, you were working, you're 65, you're done working, and you're not going back. You're done. Like, that's it. You've had enough, and the last thing you want to do is go and work for a salary again. Then the levers you've got to pull are, I can draw a bit less. I can start now by just cutting the cost. So for example, if you were planning to do a nice big holiday in your first year of retirement and the markets are down, perhaps you want to postpone that and just say, well, let me kick that out for a year. It's not kick it out for life. Yeah. That's the key to understanding this. You're kicking it out for a year because the likelihood is that markets will generally recover over a 12-month period. If not, make a new decision next year. But don't just say, well, that's it. I have to adjust my lifestyle forever. You've got a bit of flexibility. The point about freedom is it's freedom to make decisions. So once you've retired, it's the freedom to say, let me make a sensible decision now, which is, okay, I'm going to control my costs, maybe not just go and do some of the non-essential things that I would have liked to do. I'm just going to back off a little bit and just see how this whole stock market event unfolds and draw a little bit less now and maybe later in the year reassess, or a year's time I can. So that is one thing you can control. You can input that. And especially those ad hoc expenses which you possibly can delay. You can't stop eating. You can't stop paying for accommodation. So yes, those are normal. Don't panic. That was part of your planning. You got to the point of saying, I am going to spend some money to live. And so don't now, go all the way back to your 21-year-old self where you're back on the 2-minute noodles. That's not necessary as well. So controlling your expenses is getting a little bit of balance there, and then pushing out the bigger, ad hoc, infrequent expenses, I think would be an easy step to take.
Yes. Yeah. And also equally, the flip side to that is in some years, it does mean you're going to have to downscale lifestyle a little bit because you are at the mercy of the market. But also some years you might be able to upscale a bit. And now the markets have been doing very well. Like the past 2-3 years, it's been doing incredibly well. That might mean then you can go on 2 holidays. So it's never like you don't always have to think that this is going to be your reality forever. It's just being aware that this is the situation you are in now and what is the most sensible decision you can do today. And life is all about trade-offs. If you can cut your expenses reasonably, do that. If you don't like that idea, then the other option is to increase income. If you do know that, let's say by the age of 65, you're very highly skilled in whatever career you pursued. You've got many decades of experience. You can always repurpose that, maybe become a consultant on a part-time basis, or just start some home side hustle. Keep yourself busy. You're going to have all the time in the world. So do what interests you and see how you can sell that, whether that's making food or baking bread or building, doing woodwork. I don't know what's your fancy, but do something to supplement your income, because that means then you can draw less from your investments, and that will give your investment some time to breathe, at least to make sure you're not drawing into that capital and allow it to recover again. So it's kind of the two sides to it is making either decreasing expenses or increasing income, but also know that when you reach that number, be sure that it's also still invested in a balanced portfolio, because oftentimes people think, or they foresee this risk happening, and then they think, okay, I've taken a lot of risk in the markets when I was young because, I could wait it out, but now I'm retired, so I shouldn't take any risk. So I'm just going to put it conservatively. That's also a mistake, because even, let's say you retire at 65, you're still going to live for a good 20, 30, maybe 40 years. That's a long-term horizon, so you still have to have exposure to equity and property, which is more volatile, but you need to have your money last long enough. So you still need to take risk in the sense of short-term volatility, but it needs to be sustainable. Most of the time you can draw down, let's say it's a standard living annuity between 2.5 and 17.5%. Probably not the best idea to start drawing 17.5% in year one.
No, terrible idea.
It's not going to last at all. Idea. So that's where it's important to also revise your strategy every year and based off your reality that year, make a sensible decision, because any 2 years probably not going to look the same.
Yeah. And also if you know yourself and that you are more prone to anxiety and that you don't like market volatility, when you're building your investment portfolio in that first kind of transition from working to now retirement or financial freedom, it's also okay to say, well, my first year or two's worth of expenses, I'm going to actually store that in cash, which we don't like cash as a long-term investment. That's not the point, but it's just giving you that entry point to say, I've got all my expenses covered for the next 2 years in cash, and I'm going to draw from that, and I'm going to invest my money correctly in the right portfolio, and I'm going to let that do its thing no matter what the markets are doing. I'm not drawing from it, so it's growing and it's giving it the best chance to grow, and I've got the certainty of the cash. Also, that it's not decades or 5 or 10 years worth of cash sitting aside where you're losing the buying power of the money. So it just manages your psychology there, and so that's like almost a pot of money that you set aside just for expenses. Then you review that towards the end of the first year or the second year to decide if you want to do that again. I don't love that strategy forever, but I think for people going from working to stopping, the first 2 years are actually quite stressful psychologically, and it's something you got to get used to, where you've always had an incoming and then you've spent money. Now you've got no money coming in, you've only got money going out, and for a lot of people that adjustment is quite stressful and traumatic. over and above the fact that they've got to redefine who they are, because they're no longer working people, they're something else, and finding out what that is in their lives. So I don't mind that as a strategy, but it must be a limited thing that you do. And it is a key point that you're actually now a professional investor. You've gone from working for a living to investing for a living and living off your investments, which means you have to have a long time horizon. You have to have a high exposure to the stock market, to property companies, to bonds, etc. And so being too cautious with your money now will give you certainty. That's great. Well done. You've got a bit of certainty. What you've actually done is bought certainty that your buying power of your money is going to erode, and late in life you're going to be in deep financial trouble. There are other words for it, but I can't use those on a show like this. So you don't want to do that. You have to embrace the fact that markets are the tide. You're going to build a ship that can deal with a high tide and a low tide, and then just manage yourself around those circumstances. You can't move the markets. You can control yourself, and I think that that's the important point. But understanding that and making those decisions correctly before the time is very important. And if you are that person that's just going to be hugely volatile emotionally, it might mean that you actually need to do a little bit more work and save a bit more and build up your capital a bit more, so that you draw even less than what you would absolutely have to do, so that you plan for the volatility. But it's an emotional decision.
I love that analogy of you building the ship in the harbor before you go out to sea. You don't kind of build enough to stay afloat, and then you start putting up the sail halfway when there's a storm. That's a terrible idea. You need to build a sturdy ship that you don't know what the journey will look like if you have to go from point A to point B, but you build it in a way that it can withstand what you understand of a storm would be like. And that's exactly how we build a portfolio when you retire. You have to, it may not be the most fun or sexy portfolio that will get us those wonderful returns that we see online of these people taking high risk bets. But it also won't be the most stable thing that we know that inflation will erode most of the value. It's something in the middle that will withstand the storm, and it will get you to your destination. You don't want the ship that just sinks halfway through because there's no more wood left. You need to make sure that it's a balance. And yes, I think that cash buffer in the beginning is great. And also, having an emergency fund, it's actually serving almost a purpose like an emergency fund, maybe just like a bit of an inflated one, so that the way we understand emergency fund being, my car breaks down, I need to pay for it, or my dog gets sick, I have to go to the vet. But in retirement, it could also serve that purpose of, sure, we're really in a bad market crash at the moment. Let's try and not touch the portfolio or touch it as little as possible, but then we still have cash to live off of. And that is just a long-term, looking 30 years in the future, a very strong strategy, but not something you have to do every year. You don't have to necessarily, for the next 10 years, have that cash buffer. It's just that in that transition period. And also, yes, when you reach that point where you've built a life and almost an identity behind a career that you served a purpose, you've contributed to society, and now you're stepping down, you're retiring. A lot of people lose that kind of purpose that they had. Like, what do I do now? It's fun. I can sleep until when I wake up, and I can do whatever I want, but what is it that I want to do? And then they kind of go through that. I won't call it a midlife crisis because you're already past that point, but
identity crisis.
Identity crisis. So you have to find something to fill your time that serves a purpose. And it might just so happen that thing generates an income. And then, that's golden. Then you don't have to draw too much. So yes, it's a balanced approach, and understanding that the markets will do what they do, and the more risk you take, the more volatility you can expect. That's normal. It happens. Managing yourself is much more important, and not making knee-jerk emotional decisions because you listened to this news, you read this news article, or maybe just don't listen to any news. I think that's probably the best. So just cut it out.
Financial freedom means you don't have to track the news anymore. That should be a real privilege. It's the thing I work. Probably the only reason I'd actually stop working one day would be that I don't have to track the news anymore. So I agree with you. And maybe one last point around investing there is, if you're in the position where your circumstances force you to cash, in other words, you were in a company retirement fund, you moved to your own living annuity, and so the money's going to go from being fully invested to being in cash, and then you need to invest it again. It's probably the one time where you can look at market conditions and make a decision. And I'm not talking about timing the markets, because you're going to get that wrong. We all will. That's not a reflection on you or me. That's just how life is. But you can look at that and say, well, I've got a retirement fund lump sum. It's going to be, invested in a living annuity. It's 12 million rand now. And if markets are incredibly volatile there and things are going crazy, you can say, I'm going to do an automatic decision, which is I'm going to phase that money into my correct investment portfolio, and I'm going to do it over 6 months or 12 months. Especially if you're investing towards the end of a long period where markets have been doing incredibly well, it's actually probably a bit of a signal that maybe there might be a bit of a correction on the horizon. And if you're worried about that, you can't sit in cash. You can't stay on the sidelines. But what you can do is you can phase that money in. If you're about to do that big investment into a lump sum, of a lump sum into a living annuity, and it happens after a major market crash, that means a 30% crash. I wouldn't phase my money in over 12 months. I'd be kind of greedy to get in a bit quicker, because actually you're getting a heck of a sale on investment markets. So if you still want to phase in, maybe do it over a 3 or 6 month period. So that's the one time I don't mind looking at market conditions is developing a phase-in strategy. Psychologically, it helps. But for the rest, I like your point. It's subtly made that, if you are 65, you've got a lifetime of experience. You've got time, which makes you an incredibly valuable resource to people, especially as a resource to people who are time constrained. So I mean, you have the ability to give people time back, and you can charge for that, and that's a very nice thing to do. So even if you've never had a highly skilled job, you've got a car, the ability to drive, and you've got time. It means that you can sell time to people who don't have time. Whether that means becoming an au pair, driving. It seems to me, high income families, the one thing they do is they spend their lives moving their kids around. And so, you could become the driver of children, and that would be incredibly valuable to a lot of families. And then certainly, if you can cook, selling homemade food to people nowadays, I think it's something we're all short of is high quality homemade food. So there are many ideas. We've just given you 3. Spend a bit of time and you'll find a way to make some extra money that may be in alignment with your passion. So I think that's a good combination.
Yeah, awesome. Thank you so much for listening and tuning in. And if you have any questions on this, I know when the time this episode goes out, we're probably in an instance where the markets have been running hot for a long time, and now it's starting to correct itself. Correct, which means it will happen, and it will happen again, and it will happen multiple times over a lifetime. It's fine, it's normal. Just understand that is a cycle that it goes through. Manage your own emotions around it, and the more you understand how markets work, the easier it will become to manage that. And that's just building education, and that's why you are listening and watching this episode. So thank you so much for tuning in today.
Thank you to Sealand for our great shirts. As you can see, they come in all colors. And we thank you for watching and for listening. Don't forget to subscribe, and we'll see you again. Thank you so much.
Thank you. Bye-bye.
The Stradivarius violin is considered to be the most emotive instrument in the world. That's why you'll often hear it in investment ads, adding drama and the utmost importance to their philosophies, or for the announcement of a fancy new fund manager. 10x Investments don't need dramatic instruments to seem impressive. They let the results sing for themselves. So 10x your future without the drama. 10x is a licensed FSP.